Do you guys remember these images from the 2008 financial crisis? It was one of the worst financial crises in many decades. Millions of people have lost their jobs, their life savings, their homes, because some guy at Wall Street decided to abuse their power and sell a bunch of junks to people and created one of the biggest bubble in history. Many people protested in the Wall Street afterwards, demanding accountability from the people who created this mess. But while people protested and suffered, many of these Wall Street people celebrated on the balcony, sip on their champagne, and laugh at the people in their misery. None of the execs responsible for this were ever jailed. In fact, due to bailout, many people walked away with tens of millions in compensation. Now, extremely pissed, angry, unjust would be an understatement to describe the general public's opinion and feelings back then. But at the end of the day, what could common folks do? They can't do anything if the government chooses not to punish these people. After all, they have so much more resource at their disposal than rest of us. They are literally the elephants and we are the ants. But in Chinese, there is a saying that many ants coming together can defeat an elephant. And that's exactly what we're seeing this week. All these people that have lost their homes, their saving in 2008, well, these people's kids, they grew up and some of them decided to exact one of the biggest revenge on the Wall Street that we've seen in human history. So this video, we're going to dive deep into the Gamestop situation. What happened, why is it happening, what might happen in the future, and what we can learn from it. Now this video is going to be very juicy and also very long likely, so without further ado, let's jump into it. Now, as a disclaimer, I'm by no means an expert in this field. I know some basics from the start, but I'm still learning as I read more and more into it. So if I said anything that's not correct, just let me know in the comment below so I can learn as well. And also, I've broken things into different chapters. So if you know some of it already, you can skip ahead. So first, let's talk about how it started. Well, GameStop is basically what EB Game is in Canada. It has many physical retail locations, but as we know, with online sales becoming more and more prevalent, many people see GameStop as the next blockbuster for the gaming industry. It's perceived to have an outdated business model and is slowly bleeding out market cap because of lack of online sales. Now, they have changed CEO and made drastic changes to the business model, and things started to look a little bit better by the end of last year. However, many hedge fund companies still see this as a weak company. Companies like Citron Research and Melvin Capital, who would be the main character of this story, decided to capitalize on what they see as a weakness in this company by short selling it. So what is short selling and how does it exactly work? So best way to visualize is, let's use these pens to represent stocks. How short selling works is, imagine in the market, all the pens right now go for one price, which is $10. That's what people think it's worth right now. Right now, I don't own any of these pens, okay? But I want to make money on it because I perceive the pen to drop in value in the future. So what I'll do is go to someone with these pens to borrow, for example you, and I ask you to borrow these pens to me, okay? So I'll borrow these pens from you and I'll sell it to someone else who's willing to buy them at $10. So after transaction is done, this person owns a pen, I own $10, and I owe you a pen. Now, why would I want to do this transaction? That's because I think the pen is going to be worth less in the future. So right now, I don't have to return the pen back to you yet. Even though I owe you a pen, I can do it sometime in the future. So sometime in the future, let's say the pen is now worth $4 and I owe you a pen and it's time for me to pay back the pen. What I'll do is go into the market and buy the pen back at $4 because that's what it's worth right now. And then I will take it and return back to you. So after that transaction is done, you will get your pen back plus some interest because you lent me something. And I would have spent $4 to buy this pen, so I made a difference of $6. By borrowing something I don't have and then selling it to someone else and later buy it back at a lower price, I make the price difference in between, and that's how I make money. Now, by hearing this, the concept is very easy to understand, and you might probably notice that there's a discrepancy between risk versus reward. And you would be right. Eventually, I would have to take the pen, buy it in the market, and return it back to you. In this transaction, my gains are actually capped. The maximum I can make is what I sold the pen for. So what I mean is, if I borrowed the pen and I sold it at $10, that's the max I can make at most, because this can only drop to $0 and I will make the $10 in between. This can go to -1 or -2. So my maximum gains are capped at what I'm selling this pen for initially. However, on the other side, my losses can be infinite. Because when I buy this pen back, if it's worth more than 10 bucks, the difference will be my loss. So if this is worth 15, now I have to buy back at 15 and my loss will be 15 minus 10, which is 5 bucks per pen. So as you see, my gains are capped, but my losses could be infinite if for some reason this pen ends up to worth way more than what I sold for initially. So this is why short selling is an extremely dangerous way of making money, and also by doing short sell, you can potentially set up a trap for yourself called the short squeeze. And this is basically what's going on in the market right now. So let's talk about what a short squeeze is. Like I said before, when you short sell something, you're borrowing from someone else and sell it to other people. Eventually, you do have to return this pen back to the original person. Now, what happens is you can short a lot of these pens. So for example, let's say I shorted 4 pens here. So this is what I shorted and I sold it to someone else already, okay? Eventually, I have to buy back these 4 pens at whatever price it's worth in the future. Now, if I'm another investor and I see you doing this, so I know you have to buy back the 4 pen eventually, and I know in the market currently, there are only 5 pens available for you to buy. If I have the money, I can decide to buy 2 or 3 of it myself, so I put this away. And if that happens, you're screwed. Because now in the market, what's left available, it's impossible for you to fulfill what you have borrowed, which is 4 pen. And also during this time, you're paying a lot of interest on what you borrow, so the cost is starting to rack up. And so what will you have to do? Now you have to offer more money for all these people who just bought all the pen available on the market, and you have to offer maybe 5 bucks, 10 bucks, 20 bucks, 50 bucks. Technically, you can go to $1 million per pen with this.
To infinity and beyond!
Because you have no choice. You have to offer them a higher price to buy it back. So this is basically what short squeeze is. You're literally getting squeezed because you made a terrible market decision. Someone else found out, they decided to lay a trap for you, or you lay this trap for yourself already, as you see later in the story, by being too greedy. Alright, so now we understand all the short selling, what the short squeeze is. Let's move on and look at the current situation of what's happening. So how does this relate to a bunch of online retail investors? Well, some time ago, Citron Research published a report explaining why shorting GameStop makes sense, why they're going to short GameStop. Now, this ticked up a group of retail investors on Reddit subreddit, the Wallstreet bets, which are famous for making huge bets in the market. These are investors that are willing to bet their life saving away on a single bet. Now, these people have a bunch of stocks that they call meme stocks where they especially love, such as stocks like Tesla, and GameStop is one of the cult stock that they love especially. So obviously they're not happy with this. So on the forum, someone posted an idea of short squeezing the Melvin Capital and Citron Research, who have massively shorted GameStop, by using all the capital and buying as many GameStop shares as possible in the market. Now, it started as a silly idea initially, but it very quickly caught on, and more people join in on this and start buying GameStop as well. Now, on the other side, these short sellers did not help themselves at all, because they actually shorted 140% of all the available stock. So even without the retail investors buying a bunch of GameStop shares, they would have shorted more than what is available on the market already. Now here you may ask, well, doesn't that sound kind of illegal? Well, actually, you might be right. See, if people shorted shares of a company that they don't definitely know actually confirmed to exist, it's called naked short selling, and that's illegal. You can't do that. Now, online there are articles explaining that may not necessarily be the case, and I'm not saying they naked short sold GameStop. I'm just saying the 140% as of this moment raises a lot of eyebrow and suggests something like this might be going on in the background. And also, this is why most of the investors are very pissed at the situation, because it literally looks like a bunch of wealthy, greedy people overshorted themselves, created a trap for themselves, and they brought this situation onto themselves. So now the stage is set. This is literally what happened, how the average Joes on the internet were able to come together and cause billions of dollars of losses for these genius investment firms and hedge fund managers. Now, these kind of big squeeze are not new, and actually something like this happened before in the 2008 between Porsche, Volkswagen, and a bunch of short sellers. So let's go off a little tangent and talk a little bit about that so we can learn from it and how it's different this time. So after 2008 financial crisis, Volkswagen were one of the companies that were viewed to have a very high chance of bankrupting. And again, short sellers looked at this and they want to target this company to potentially make a massive profit. So they short sold a lot of Volkswagen stocks. And they were very confident because by then, one of the biggest stakeholder, Porsche, who owns 30% in Volkswagen, have previously announced they're not looking to increase any more shares. And short sellers are now feeling confident because there's a lot of shares on the market for them to short sell. But just over the weekend on October 26, 2018, Porsche actually came out with a surprising statement saying that they have silently acquired an additional 40-something% of Volkswagen stocks, bringing them from 30% to 75%. And by then, the short sellers' total borrow amount made up to be 12.8% of all the Volkswagen shares. Well, that should still be okay, right? Porsche owns 75, we are supposed to buy back 12.8. There's still some room for us to play around with, right? Well, not really, because the second largest shareholder is Lower Saxon, which is the home province of Volkswagen in Germany, and they for sure are not going to sell their shares. So overnight, the situation became there's only 5% on the market for you to buy back, and you shorted 12.8% of the market. And because of this, in the end, Volkswagen share have peaked over €1,000 per share. Many people call this the mother of all squeeze or the infinity squeeze because as you saw, the stock price were going to go to infinite. Now at the end, Porsche settled. They negotiated with the short sellers and they took out just enough shares at a very high price to sell it back to them, so the short sellers can cover the position. At the end, Porsche have netted a total of $10 billion from this transaction, and the short sellers have lost a total of $30 billion. Now here's the question, why would Porsche settle? Shouldn't they just keep holding on and keep squeezing them to infinite? Because as you saw, the stock price is going up and up and up. No, the reason is because it's not a business best interest to do these kind of things and cause someone else to bankrupt. Because in the business world, you don't want to make enemies, and also it's a powerful thing for these billion-dollar hedge fund company to say they owe you one if you let them off their hook with massive loss, but not enough to bankrupt them. So that was what happened back then, but this time, it's a little bit different. This time it's different because there's basically no one big company that is trying to squeeze these hedge fund companies. The squeezers are made up of millions of individual retail small investors. You know, the people that Wall Street deem that's not very sophisticated, the ones that are supposed to be individual, disorganized. Well, they're able to band together and now it's short squeezing these hedge fund companies. And there is no one you can negotiate with because they don't need favors. They're not a company. They don't care about bad PR. There's no such thing with them. And also, these individual investors just own a fraction of the market. So even if you can convince some to sell, it's not going to help you to cover all the position you've shorted. So these big companies are really stuck between a rock and a hard place. So what do they do next? Well, many interesting things have happened, and some people would call it playing dirty. So some news network have actually launched a full-scale segment running 24/7, trying to favor the Wall Street people and paint the online individual investors as the bad guys who are manipulating the market and squeezing money out of these billion-dollar companies. Which is really ironic because in some interview that I watched, these Wall Street people who were being interviewed actually pretty much admitting that they have been engaging in market manipulation. There's also a lot of misinformation. For example, reported that Melvin Capital and Citron Research have closed their short position, which meant they took the massive losses when it turned out that wasn't true. They still have their short because these kind of shorting information is available to the public. Anyone can go online and verify if these are true or not. As of this moment, short position is still well over 100%, suggesting that they really didn't close out their position, at least not everything. And also one very interesting thing is, I start noticing ads that Melvin and Citron have closed their position. I mean, if it's facts, if it's true, why do you have to buy ads to try to convince me it's happening? It just doesn't make sense at all. And also on January 28th, on Thursday, many trading platforms like Robinhood and some others suddenly do not allow retail investors to buy any more GameStop, AMC, Nokia, or BlackBerry, etc. All these stocks that were hotly debated in the short squeeze scenario, while they allow people to sell. So once you sold, you can't actually buy it back on those platforms. Which later on they came out and explained this is a move to try to protect the investors, and it makes no sense. Because if I was buying on margin, which is basically borrowing money to buy on the stock account, fine, you can restrict me because you see this as a too volatile market and you don't want to lose money and unable to cover it. That makes sense. But what if I'm buying with my own real money? Why can't I buy a stock that I believe in with my actual money? So because of this, many people actually allege them of teaming up with the Wall Street buddies and try to help them out by restricting retail investors from buying these stocks. See, there's something called the Streisand effect, which means the harder you try to remove something on the internet, your action of trying to remove that thing actually causes more people to find out about it. So all your action actually produce the opposite effects. And that's what we're seeing here. It has blown up so much and got so bad that AOC, Ted Cruz, and other people all joined in to say the same thing. And that is the system is favoring Wall Street people, and now they're crying about it because they made poor decisions and they're losing for the first time in history. See, how bad do you have to screw up to have AOC, Ted Cruz, and Donald Trump Jr. all saying the same thing to you? And this has actually brought even more people to jump in on the hype train and bought GameStop share just to stick it to these billion-dollar companies. For example, I myself was just sitting on the sideline reading and studying about this. I wasn't going to jump in, but after all the platforms shut down, I actually went and bought a share of GameStop. Now, I'm not telling you to buy a share just like me. I'm just saying all the things they're trying to do to push down the price, to manipulate people's information, have actually brought more people into this battle against them. Alright, so basically that's what happened. You've caught up all the way where I'm filming this video right now. So let's talk about what will happen next. So I actually had to redo the session because so much have happened after I've recorded the video. Now in there, basically, as we see right now, GameStop is at a double-digit price, so it has dropped many percent back down to below 100. So some of the stuff that I said could have happened. For example, I was saying that potentially there could be a lot of short attacks launching against this price to bring it down. So short attack is basically when there is a lot of small volume trade at much lower price that is trading consistently to trying to trick the algorithm to push down the price. That's one of them. As we can see on the screen here, there's a lot of short volume trade happening for the last couple of days. So this could potentially explain part of the big drop. Other than that, there is also the fact that a lot of trading platforms have restrict or completely closed off buying GameStop and other similar shares. So if that happens, basically they're cutting off the demand, and if the demand for the retail investors are affected, then obviously the price will go down as well. Now, other than that, there are many theory and guessing on why the price is dropping so much. One of the most common one is that actually hedge fund companies have placed even more short and more bet at the high price, betting that it's going to fall from very high price to very low. So they will be able to make gains on that drop to cover all the losses they still have by holding the original short positions. Another theory that people keep saying that also makes sense is that for these hedge fund companies, they actually do not have to cover the short just like a regular person. They have many tools that they can technically delay the short down the road, so then it looks like they are covering the short, but all they're doing is just pushing the actual short position further and further down the road, so they buy time for themselves. Now finally, another popular guess is that maybe the company has covered the short position already, and we just don't know because everything is operating behind closed door, so people can only guess by looking at the available public information, and they don't really know what is going on inside. The fastest date we'll find out is February 9th, where all the short interest will get updated again because it's a 15 days update cycle. Now today I actually saw Mark Cuban did a Ask Me Anything on the subreddit Wall Street Bet, where many people have asked him different questions, all revolving around the GameStop situation, and he actually has some pretty interesting insight and answer on that. So I have provided a link in the description below, so if you're interested to read his reply, you can check the link below. Alright, so finally let's move on and talk about my thoughts and what we can learn from this situation. Now first of all, this situation, I love it. And it is especially delicious when it's happening to short sellers. See, in my opinion, short selling is probably one of the worst way you can make money on the market, because to me, it's extremely unethical. When you short sell a stock, you're actually actively trying to ruin a company by driving the stock price to the ground. Because when you short sell, you're borrowing a bunch of stocks that you don't own, and then you're massively selling it to the market. Just by increasing the supply by so much suddenly, you're going to drive down the stock price regardless what's going on with the actual company. So the fundamental, the cash flow could be very strong, but just by you short selling, you're actually driving down the price artificially. And this is going to ruin a lot of people who actually believe in the company and hold the stocks for long term, or others that are actually working in the companies. So you can potentially ruin a lot of people's finance and even their lives by short selling a company. And this is also an interesting case of the prisoner dilemma and what happens when you give it time to evolve and let the prisoners communicate. So the classical prisoner dilemma is basically two people separated because they're prisoners, and they're saying you committed a crime, so if you betray the other people, you walk free and he gets double sentence. If you both work together and you don't admit to the crime, you both get reduced sentence or no sentence. And if you both admit to the crime, then you get equal. So at the end, because of lack of information, it's always better to betray the other people. And this is why retail investors, it's very hard to come together and do something together. Because of lack of information, they're always looking out for themselves. So as soon as they see an opportunity to make money, even at the expense of other people, they will just do so because they are not sure what the other people will do. And this is basically the difference between the institutional investors versus retail, right? The lack of information. And this is what happened here. With the rise of social media, it's so much easier to exchange ideas and talk to each other and communicate. Versus before, the rate you're spreading information is very limited. Now they're able to come together and create this Gamestop short squeeze. Now, but having said that, many people were saying, well, because they've done the short squeeze on GameStop, they're gonna do the same thing to other stocks like AMC, BlackBerry, Nokia, and this is why all these stocks have also gone up in the past week. One thing I do want to caution on is the GameStop situation is unique only to the GameStop stock. It's not gonna easily be repeated on other stocks just because those stocks are being shorted. I'm not saying it won't happen. I'm just saying it's not a sure thing. So just because someone say, oh, go buy AMC, go buy because it's the next GameStop, you're gonna be careful and don't just get hyped up and then go in. Which brings me to the last point, is the difference between long-term investing and short-term investing. And this GameStop situation is a very good learning lesson. So for long-term investing, it's a win-win situation because as long as the economy do well or the company have strong fundamental, they make money, they perform, they improve, the stock price will go up by itself and everyone will be able to make money and grow their wealth. But this takes time for the economy and the company to do well. Short-term investing, on the other hand, is trying to make gains before all these economic and company growth can settle in. And when you do that, it's no longer a win-win situation where everybody in general can make money all together. It's a zero-sum game. Meaning, if someone was to make money, then someone else must lose when it comes to short-term trading. Now, in the GameStop situation, it looks like the retail investors are winning because they're coming together, they're pushing up the price, and the hedge fund company are losing money. But in reality, 8 out of 10 times, the situation and scenario is completely reversed. It's the retail investors that are losing money and the big companies are making it. And the most important reason is the difference in capital and information. See, you can't move the market with your tens of thousands or even millions dollars in the market. It won't do anything. It won't make a dent in the market. But the hedge fund companies with their billions and billions of dollars, every move they make can potentially send a ripple effect to the market and actually swing the price in either direction. And this will work especially well if they work together with other big whales, other hedge fund companies, and coordinate together. Now, I'm not pointing finger to say who is manipulating the market, who's not. I'm just saying likely these kind of things are happening all the time in the background. And maybe unknowingly, you might be sucked into it and you might be a victim because of short-term trading. So this is why, as you see from my videos before, I'm more about long-term holding and not short-term, because I neither have the capital or the information advantage to get ahead of the market short-term wise. And with long-term, I can research about the product and research about the actual market, the CEO, the board of directors, the direction of the company, to give me a much better chance of selecting a company I feel comfortable about. Alright, so that's basically everything I want to talk about for this week. Let me know what you think about the GameStop situation. And if you like these kind of video, I do upload them 8:30 EST every Tuesday. So make sure you like and subscribe to my channel. Click the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!